Bill, how you doing today?
Great, Ryan. How are you?
Doing good. I am super excited to have you on the show. You and I were sitting down in sunny Palm Springs chatting about your crazy background over the years of doing what you've been doing at EY. And you were telling some amazing stories. So I just literally couldn't wait to have you on the show. But for the listeners that were not able to sit in, which is probably a good thing on some of the fun conversations we're having, why don't you just bring everybody back and kind of give us a little bit of a debrief on, how did you get into M&A and, kind of your career path at EY?
Well, sure, Ryan. And thank you for letting me be on your program. Really appreciate the opportunity. So I've been with EY since I got out of college, and which was an unbelievable 35 years ago. And I started my career with the firm back then in audit. And audit is a great background for anyone going into business. I mean, at the end of the day, accounting is the language of business. So I got a really good start in the audit world, but I wanted to do more. I got an MBA at night, and I got really, really interested in the deal environment. And so I made a career change at that point in time where I started at that time, I was a junior guy, and we had some partners that were looking at putting together a new business offering for us, which is to really work with companies and helping them execute on deals. And at that point in my career, it was really all about doing financial and tax diligence. And we were primarily working for the CFOs, financial reporting professionals, and the tax team. But we always aspired to do so much more. And so much more is the journey that our practice, which is called Transaction Advisory Services at EY, we always aspire to be the main chief trusted strategic advisor to the C-suite. And if it's private equity, it's really to the private equity fund professional. And we've always been on that path. So I was really excited about that, inspired to do that. And I had an opportunity early on in my career to work in São Paulo, Brazil. So I was sent down to São Paulo to put together a transactions practice. So I worked in São Paulo for many, many years, and at which point I moved back to the States. And I've had this wonderful journey with the career with the firm, whereby I started really at the front end, which is doing diligence type work, to where now I've worked on some of the largest transactions in the U.S. In fact, our practice has worked on 17 of the top 25 deals. I mean, we don't necessarily, there aren't league tables with respect to advisors from a professional services perspective, but if there are, we'd obviously score very, very high. So over all these years, the types of transactions that I've worked on, the spaces that I've touched, whether it's transaction processing, I've worked a lot in the beverage space, primarily in beer and spirits. I've worked in a lot of different sectors, but I've also worked in a lot of different geographies. And I had just a lot of fun building out our practice in Latin America. I've had the opportunity to work in pretty much every market in the Americas, from Canada all the way down to Argentina. I picked up Portuguese and Spanish along the way. And in addition to working on some very, very large, complex cross-border deals, I've worked on a lot of fun one-off deals. I've done some alligator deals. I live in Miami, so those are always been kind of fun. And so from alligator deals to toilet seat deals to you name it, I've covered it. And so, look, it's been a great journey. The deal market has evolved over the years. It's become so much more sophisticated. And now we have professionals on our team that not only have very deep sector capabilities and experiences, but we also have folks that have very diverse functional skills, whether it's in IT, finance, supply chain, etc. And now even those functional capabilities are getting very sector specific. So, it's been a lot of fun for me. I mean, this practice has grown to where we're at now. We have 4,000 professionals. We're about $2.1 billion in revenue. And last year was a great year for us. We're having a great year already. And all the things that are happening in the deal market right now, tax reform is clearly going to have a positive impact on the deal market. So, look, this is a great time to be an M&A professional. It's a great time to be in the deal space. So, we're really very positive about the outlook for the market, certainly for calendar 2018.
Well, and I'm so excited to be able to get you on the show because, I had James Markham on the show. So we were talking about some of the tax reform and tax changes that are going to be happening. But, with your exposure, Bill, I mean, you've got such an amazing, vast variety of deal flow and the things that you're seeing. And I think that's an important thing because a lot of entrepreneurs, they get, one-off advice or opinions. And with just the sheer amount of data and things that you see, I think you're able to pull out trends. So, maybe if we could, kind of go through, correct me if I'm wrong, but EY just released their M&A survey report, right? Which is kind of like the state of the market or something.
Correct.
So can you maybe give us some of the main takeaways and we can link to that in the show notes if the people need to, but, what are some of the big takeaways that you guys found as you went through all the data that you guys gathered?
Yeah, so twice a year, we release a capital confidence barometer. And this is a survey we do globally, as well as in the Americas and more specifically the US. And so we survey deal professionals in the corporate and private equity space to get a sense for what are the trends, what is the confidence and the expectations around doing deals and overall health of the deal market. And I would say over the years, our survey has been relatively predictive. And so once again, based on the results of our surveys, so the optimism in the market continues to be very high. So let me just give one example of a lot of different statistics that I could throw out, but I think this one is quite telling. If you look at companies that are greater than $5 billion of revenue, 75% of these companies plan on doing deals within the next 12 months. I mean, these are historic levels of confidence within this market. And then if you look at more smaller, more middle market companies, all of the reasons to do deals continue to be the same. And that's what's driving the deal market. And this was pre-tax reform that when we did the survey. So, what are those reasons? Why are the conditions so right? And, I'd say, first and foremost, a lot of companies continue to build cash on their balance sheets. For companies that have shareholder activists that are involved, activists are looking for growth beyond organic growth. Now, we've come off a pretty decent year in 2017 of GDP growth. GDP growth, I think, for the year ended up 2.6%, plus or minus a few basis points. And we had a couple of quarters last year where we got around 3% GDP growth. Pretty strong for the U.S. considering where we're at. The credit markets continue to be very, very healthy. And first and foremost, companies continue to need to innovate. And you're always faced with the build versus buy. And so innovation is a key driver, but we also see, this convergence of sectors as well. Technology companies being paired with the automotive companies and the consumer products companies. So, first and foremost, it's really innovation and companies that are continuing to try and future-proof their business models compels them to be active in the deal market. And so the converse of this is also the divestiture market. So, likewise, we do a survey on divestitures and divestments as well. And we're seeing a record number of companies that are focused on divestments in 2018. Close to 90% of the companies are considering to do a divestment. And again, it's divest to invest. Focus on the core, look at those assets perhaps that are not aligned with your strategy, positioning those companies, positioning those particular assets, getting them ready for sale, propping them up, making sure you got the IP lined up, you have the appropriate transition agreements to sell those businesses. So we're seeing this real uptick in divestiture activity, which bodes well towards continued M&A. And then on top of all that, you layer tax reform. And so, how much of the tax reform will be reinvested in acquisitions remains to be seen. But there's no question that there will be an uptick in activity, if not only solely for the fact that deal markets are always impacted by uncertainty in the market. So leading up to tax reform, there's certainly some level of uncertainty as to where this was going to end. What was the corporate tax rate going to be? What was the impact going to be on the repatriation of offshore profits? And now that we have that certainty, both on the corporate strategic side as well as on the financial private equity side, now the buyers in the market have certainty around that. So just by the mere elimination of the uncertainty around the tax code and tax reform, that frees up the deal market. And then on top of that, obviously the corporates are going to have even more cash on their balance sheet. So you put all this together, we're expecting a very positive deal market for 2018. And then January of 2018, from a deal value perspective, was one of the highest months on record. So, right out of the blocks, we're starting out the real strong deal market. So, we continue to see, and certainly just the level of deals that, my team is working on, the outlook for 2018 is pretty positive.
With all those different things that you were saying, I mean, you touched on a lot of different really interesting facts. And, one of the things is about, first of all, the optimism, the fact that there's clarity, because now we actually have rules of the game. So actually people know what game they're playing and what's going to be available to them. But, one of the things that you'd said, Bill, is the kind of the different sectors as people are divesting or they're trying to innovate. You got the automotive industry and software, and a lot that the technology enablement in different industries is very interesting. I think there's a lot of blending. What are you seeing is that, because I think the buyers are no longer the usual suspects anymore, because especially with a lot of the corporate profits that are coming over, people are going to be able to, if they're planning on selling, it's not just the typical buyers anymore because of the technology, the different money that's flowing in. What are you seeing as far as like that whole landscape of the different, things that are the different industries and sectors that are moving in on each other?
Yeah, no, I think that's been, a trend that we've seen now for the last couple of years, which I think is really, really exciting. And again, I'd say, where you first saw it was really, the automotive space, where you have automotive companies that are viewing themselves now as technology companies. And so therefore, in terms of, I go back to the years that I did deals for the automotive companies, where they were primarily focused on buying out parts companies. Now you're seeing automotive companies making big bets on technology. And, it's really kind of changed the landscape, from a deal perspective. So, and you also see that in consumer products, in terms of consumer product companies trying to better understand their customers and their behaviors. So, you have a convergence now of sectors that we didn't see before. And I think we're going to see more of that, and we'll continue to see different sectors that are now converging and deals that that are very, very different than what we've seen in the past. So I think again that goes more towards innovation in terms of connecting with customers, that I think crosses all kinds of sectors, and obviously increase the amount of deal activity that we'll see.
How does that impact the valuations, right? So if you got a company that is trading on a multiple of EBITDA or profit versus the software companies that are a lot of them are valued on recurring revenue and all these different, there's all these different rules that are kind of slamming into each other. I mean, what are you seeing on valuations and sectors and such?
Yeah, I'd say fundamentally, every company should be valued obviously based on its future discounted cash flows, for sure. And so that is a far easier task on more traditional companies. When you can nail it down to specific units, and you have history, and you have a fair amount of data that one can look at. When you start moving towards more technology-based companies, whereby the technology is new, it is not necessarily market proven, the valuations can be more challenging. And then you also bring in a broader sector of buyers. So if you're on the seller side of that, and you have a technology that is very, very innovative, and the market potential is not as precise, then obviously, that bodes quite well. So, as a result of that, obviously, the more a company can position itself as a technology company, leading edge, it's likely to have a positive impact with respect to its valuation. So that's a little bit more of an art than it is a science, and I think that's where it requires a very, very astute buyer, because obviously one needs to place their bets very, very carefully in terms of looking at that technology, the scalability of that technology. How future-proof is that technology? So, it certainly adds another layer of complexity with respect to doing deals.
So let's say the buyer's actually very eyes wide open. They might actually understand technology versus just trying to pretend like they're trying to get into the game. I was actually just getting done with this book, and they called Walmart's acquisition of JetBlue as putting hair plugs on someone that's going into a retirement facility. It's just like it's an interesting way to word it. But when you're dealing with, aside from the numbers and merging these companies or the acquisitions that they're doing, what are you seeing with the ability to integrate the cultures and the ways of operating companies? I mean, how this, I guess that kind of goes into the success of actually completing the transaction and having it afterwards. I mean, what are you seeing as far as how they're able to merge cultures and different operation methodologies?
Well, it reminds me of the old line, right? Is that culture always beats strategy. And so getting the culture right is probably one of the most difficult types of either, I don't know if synergy is the right word, but clearly when you integrate two businesses, getting culture right is by far the most challenging aspects of it, because generally you have two organizations and the team members of both of those organizations, obviously have a strong affinity with the culture of the legacy business. So when you put those two together, and it's preserving what's great about, let's say, the target culture, and then bringing that under the umbrella of, let's say, the acquirer. Sounds easy to do. In reality, it is quite difficult.
Right.
And I would say the complexity increases based on, let's say, how much of the revenues are, let's say, more of employee dependent as opposed to machine. So, as you move more into, let's say, more of a professional services type business away from straight on manufacturing, that gets more and more difficult. But I would say that, clearly doing your homework up front, being very, very sensitive to the cultural side of the equation and getting the right balance, because there's always a balance, right? So there's a temptation to, let's say, to fully integrate and bring in the other, let's say, the acquiree as quickly as possible to capture the synergy. So that's the other side of it. So you have the synergy capture, the market is pushing hard, they want to see the synergies within the deal. But if one pushes that too fast, too far, then you sacrifice, obviously, the long term in terms of having a motivated workforce, high retention rates, and it requires a very, very careful balance. So that is something that requires, some homework up front, getting folks involved from the acquiree standpoint in terms of how best to inculcate these cultures, I think is just absolutely critical.
Yeah, it's like the numbers can be, done in half a day, and then there's the people element. It's totally the variables that are not predictable. If someone's trying, you've mentioned it a couple of times, future-proof their business, and I think that's, as we've been alluding to, like the technology and then the traditional industries, what are some, other than the automotive industry, what are ways that you're seeing people future-proof their business with different acquisitions or the innovation? I mean, is there certain trends that are popping out more than the others?
I'd say first and foremost, one of the things that's really, really helping companies quite a bit, and something that we've certainly been working with our clients, is data analytics. Using data analytics and technology to really mine your customer. We'll start with the customer. To really mine your customer base, to understand your customer behaviors, your customer trends, so that you can spot movements in your own customer base and trends within your business to give you more lead time to respond to it. So I think, what we're seeing is, companies that are able to innovate and are able to adapt to the markets have that ability to do that. So I think, the ability to use data and technology to better understand your customers clearly gives an advantage. I'd say another side to it too is turning that around in your operations. The ability to really challenge your supply chain, challenge your vendors, look for those cost opportunities to provide, and again, that provides the organic capital that you need to continue to invest in the business. And I said before, companies that are kind of leading in their segments are companies that are really taking a hard look at their portfolio of businesses and really challenging whether or not those companies or those business units are performing. And if they're not, they're moving on those rapidly. So I think, again, it's using technology, using data analytics to your advantage to help you better manage your business, I think is quite key.
Do you think there's any industries that, are overly exposed to the longer ability to actually accomplish what you just discussed?
I'd say as from a sector perspective, I think the answer to that is no, because I think there's always players within these sectors that are, that are focused on adapting, that are focused on innovation. The companies that are going to be that will have a challenge are those that are not, the ones that are not challenging their portfolio, the ones that are not looking around the corner to see where the next innovation is that will disrupt their business model. So I think in every sector, you have the companies that are out there that are being innovative. So the issue therefore then is, if you are not one of those companies, what are you going to do? And what are the next steps in order for you to maintain your business? I think that's what we see.
Yeah, and I think that's a very good point. And I'm curious on what your perspective is, Bill. So when you think about there's a wave of baby boomers that are going to be trying to sell their companies in all different sectors, right, or in all different size of companies as well. And I think there's this whole. There's a lot of owners that have struggled to actually start with the end in mind and actually plan for an exit. It's a little bit different in the IPO world, or the people that are actually living and breathing on deals. But when you look at so how do you tie in? I guess what the question is I'm asking is about starting with the end and who you want to sell to and what your exit is. How do you see the success of that, and how much more important that is based on what you just said? Because knowing where your company and your industry plays and who you could potentially sell to, do you see people actually planning that out that much, or do you see like an actual issue where there's not a runway of 10 years to plan this out because your industry is changing and you're not even thinking about who you're going to sell to? What's the spectrum of what you see from the people that you get exposed to?
Yeah, I would say a lot of this kind of depends on where the life cycle of the company is, and also, let's say, the dynamics of the investor team. But a lot of times, companies, let's say, hit the wall in terms of just their ability to expand. So you think of let's say a smaller mid-market company, and they realize that there is a tremendous market opportunity for their company, their service offering, their product, but their ability to seize that opportunity is limited. It's limited because they don't have the capital, or they don't have the distribution channel. And that's when either, let's say, the first step could be an alliance whereby, all right, these are my products. Let's push them through your distribution channel. Let's take a look at the synergies. And oftentimes, alliances are the first step to an actual acquisition. So, from one perspective, it could be, do we have the ability to raise enough capital to fully exploit this opportunity? And the answer to that might be no. So the right course of action is, let's sell. Let's sell to a strategic, or let's sell to a private equity firm, and we maintain part of the business, and we leverage the private equity's ability to raise capital, the private equity firm's ability to bring in some seasoned management that's already gone through this. So that often is the trade-off between, do we go with a financial buyer, i.e. private equity firm, or do we go with a strategic? And and so I would say there's choices there, and oftentimes it's just generational. You'll have a owner entrepreneur that has had a great run with the company, and now it's time for the next generation, and the next generation may be a financial buyer or a strategic. So there's a lot of dynamics that go into this, but I think oftentimes we see it's either for the ability not to have the capital that's required to get to the next level, or I'd say even more so now. More so now, it's companies realize that by aligning, with a strategic, they can see the incredible synergies that their technology, their service offering, their product can bring to this company to, future-proof the business. And that's why we see a lot of these technology plays that are aligning with the consumer products industry, the automotive industry, the life sciences. I mean, I could keep going.
Right. So I'm curious, Bill, like when I think you brought up a huge point, which is strategic versus financial buyer. And there's, been a lot of PE firms that are trying to deploy their dry powder and the extra capital that's been sitting on the sidelines, but then I believe, from what I've been seeing, with the smaller, beta or the smaller test group of the people compared to what you're seeing is there's going to be a lot more strategic sales probably going to be coming down the pipe because of the corporations with the extra money now that's coming back over, and or the technology that people, the different sectors that are intermingling. As far as all the deals, are you seeing that? Is it more leaning towards strategic? And then if so, there's so much more thought that has to go into where you might find that person. So I guess the ratio, is there one, weighted versus the other?
Yeah. So look, we kind of roll the tape back. Private equity has been, on an uptick from a deal perspective, been an uptick for probably about almost 2 years now. And as a result of that, the fundraising and the amount of dry powder in private equity globally, it's almost $1 trillion. And in the U.S., it's probably, or I should say North America, it's probably north of $600 million or $600 billion. There's so much dry powder right now in private equity, looking for deals. So, we've seen a big uptick in private equity in 2017. We're seeing it now in 2018. So, we continue to expect to see an uptick in the amount of deal activity, for private equity in terms of, if you just look at the deal share of private equity and just in the number of deals in the U.S., that number is trending up. So, I think overall, the deal market, we expect to see an uptick in the deal activity. So, I think both the strategic deals and the financial/private equity deals, I think we're going to see an uptick, in 2018. Now, in terms of, again, from a seller perspective, is it always about price? Am I going to give it to the highest
right.
bidder? Yes, no, maybe, but there are many, many, many reasons why a seller will go down the path of a private equity firm. They'll use a private equity firm again because a private equity firm is going to provide them with their ability to continue to run and manage the business, but also will provide them with some operating expertise, management expertise, some representation, different board members, as well as other options with respect to an exit. So, I think for both the private equity firms as well as on the corporate side, again, I think the market's going to be pretty strong on both sides.
I want to expand on that a little bit because I think you actually hit on something that's super important, which is it all about the price. And so when you look at the decades of that you've been doing this and all the different, exposure to different industries and size of companies and stuff, when you eliminate the price, Bill, what are some of the things that a seller should be thinking about with a potential acquirer that, that is different than the price? What are things that they should even just start asking themselves that are important to them?
Yeah, I think, look, so we'll go down the path of, let's say the seller wants to remain in the business. So, if you're going to go down the path, private equity, what is your percentage of control going to be into that business? What role will you have in that business and the decision making? And what are the next steps post a private equity? Typically, the typical life, the typical span of a fund is going to be between 5 and 7 years. And if your aspiration is once you sell the business to stay involved in that business, you're obviously going to you're looking for a path beyond the horizon of having the private equity firm involved in your business. And so, that's I would say in terms of going down the path of a private equity firm is, in addition to the capital, what else are they going to bring in terms of helping you grow that business, expand that business, within, let's say, their portfolio of companies, going forward. So the flip side of that would be, from a corporate perspective, if you're just doing a straight sale, and are you going to get cash or are you going to get stock? If you're going to get stock, then to what extent are you going to be part of the management of the acquirer where you could have some influence on that stock price going forward? So, a lot of aspects to consider if you are a seller. I think one is, a lot of it has to do with first decision, what is going to be your involvement in the business going forward? And if the answer is, I want to continue to be involved in that business going forward, then the next question becomes, what is your aspirations with that? Do you want to continue to lead and grow that business, or do you want to be part of a broader company where you're running a business unit. All of those aspects kind of come to play, and depending on where you fall within that continuum, private equity might be the right path for you, or perhaps corporate would be more aligned to what you would like to do, and your management team.
So how does, I think you highlighted some amazing points there. And if we were to take that a step further to actually the way that the deals are being structured, is there a trend that you're seeing as far as like how all these are being financed or structured, or whether it is stock or cash or whatever it is? I mean, is there certain things that you see more frequently than others?
I think one thing about the capital markets as it relates to doing deals is that if there's one area that there's been constant innovation, it's on how deals are structured. And so, one would say, well, is private equity disadvantaged because of tax reform? Yes, no, maybe. And I would say, the private equity firms are quick to innovate, quick to come up with, structures that will continue to be attractive both not only for the PE firm, but also for the investee company. But I would say, clearly, look, there's been a run up on the stock market. I recognize there's been some jitters over the last few weeks here, but when you have these valuations of the way the stock market is performing right now, clearly, that from a corporate side, you have stock valuations that are very, very high, combined with tax reform putting more cash in the coffers of the corporates. You're likely to see on the smaller range, you're likely to see some fairly rich cash deals for sure. We haven't even talked about the implications of repatriating cash held offshore. So likely, and again, with credit markets being very, very favorable here, you're likely to see on the lower end probably a fair amount of cash deals where using stock is probably not necessary, probably at the lower end of the deal spectrum.
Well, and then so maybe because I think what is another variable that even compounds on top of that is that you can expense an asset purchase then in 1 year, right? So if you got cash, you just want to buy that asset. I mean, you can just literally write it down the first year, correct?
Yeah. So at a very, very high level. So with tax reform, obviously we pushed it on corporates. The tax rates dropped from 35 to 21. We've changed the deductibility of interest, which will make, let's say, financing a deal less attractive than it was previously. However, the offset to that, of course, is when one buys assets, one can depreciate the asset up front, assuming that one has the income to offset that with. So, that is easy, that sounds pretty straightforward, but like everything else, one needs to be careful, because the last thing you want to do is turn a current deductible expense into a loss carry forward, that's subject to certain limitations. So, hence the reason why, like everything else, to say, reflexively that tax reform, would disadvantage the private equity firms that are using, leverage to do the deals versus corporate. The analysis, as you can see, is a little more involved with that.
Yeah. And like you said, people get creative when they're trying to get deals done.
No question. No question about it.
So, Bill, I want to kind of maybe change a little bit of gears, because I think, when we talk about the team and like what should someone that's selling expect from who's involved, who are the different people? And I know EY does an amazing job for the certain types of clients that they have. What are the roles that people should be bringing on? Because I know that's kind of what the TAS team that you've kind of put together. Can you kind of explain the different types of functions? And you even mentioned at the beginning that it's gotten even more specialized. But if someone's looking to start building their team, what should that actually look like?
Yeah. So, great question. I would say, first and foremost, for an entrepreneur or a management team that's looking at selling the business, I would say, first and foremost, preparation is so important. The last thing you want to have happen is for a prospective buyer to find, problems, some challenges, some inconsistencies in your financial data, your tax data, some perhaps legal matters that you are not aware of. That's the last thing you want to have happen. You want to do your own internal diligence first before buyer, so that way you can anticipate questions. You can anticipate how that might impact your valuation. You can present it to a buyer in a way whereby you can help them understand how they might be able to manage that risk, and that's just absolutely critical. And I think also as a management team, understanding what the value drivers are in your business and your ability to articulate how your business adds value to the market. How are you positioned against your competitors? Where are the opportunities to grow the business? If you had more capital, how would you grow this business? And helping the buyer understand that, and how your company is positioned to compete. First and foremost, and I think in having the various members of your management team, because what's going to happen is when a company comes in, whether they choose to do this in-house or they more than likely use advisors, the advisors are going to be, as part of their job, they're going to be looking for that. I mean, not only are they looking for areas where there are values, but also where those vulnerabilities are. And I think the ability for a company to get ahead of that curve, to be proactive in presenting that information to a potential buyer is so critical, because it first and foremost, keeps the confidence high in the deal. It gives the buyer confidence in terms of the price that they're willing to pay. And I'd say most importantly, it just speeds the process to close. And in all deals, time is never on your side. And the ability to close the deal, rapidly is always in the advantage. It just eliminates all the uncertainties that can appear, while time drags on. So, that would be probably my most important advice I could give to prospective sellers.
Well, and what did you say at the beginning of the show too? You said finance is the language of business, right? That's what tells the whole story.
Absolutely. Absolutely.
So maybe expanding on that a little bit too. What do you see, Bill? Because there's all these stats that float out and where people get them and whether they're valid or not, to be determined. But 80% of deals fall apart in due diligence or whatever it is. But can you explain? Because I agree. I think that is huge advice. Everything that you just said, and it's a painful process to do that, because you don't want to, and people get forced to do all that stuff in the middle of a deal, and they see the price decrease or the deal fall apart. But what are some main things as people are going through that process that they should really be focused on? You mentioned the legal matters, but is there maybe expand on the value drivers or the finance due diligence stuff? What are the things that you see people do well or really, really miss on when they actually should be focusing on it?
Yeah. And I'd say first and foremost, there's certainly, obvious things that are going to drop. The numbers don't prove out to where they should be. There is a tax claim that no one understood, or there was a either deduction that didn't quite fall through, those sorts of things. But I would say, and sometimes those can be overcome. But what can't be overcome is that, particularly if a prospective buyer is buying a management team, and when that management team presents the business, and there is not a shared vision where the opportunities are for the company, where the business is headed, and a full awareness from a strategic perspective of how this company, where it adds value, how it's going to future-proof itself, how it's being innovative, what distinguishes it, from its competition. If that isn't clearly articulated by the entrepreneur and the management team, if deals go sour for one reason, aside from, let's say, the obvious, let's say, foot faults, it's going to be on that. It's going to be on the quality of the management team, their ability to articulate the value of the business.
That's huge. I think that's a very good point. What are ways that people what are some cool ways that you've seen companies actually align their management team? Is it something where they staffed up and got just a killer management team because they work so hard? How do you develop that shared vision and the quality of people that that you need?
Yeah, and a lot of that really is leadership. It's going to be leadership from the CEO perspective, the entrepreneur perspective, and it's also culture. And it's a leadership style which will then be brought through the organization, inculcated in the organization based on culture. And buyers can feel that, they can sense that, and they can see that every person that they talk to, that they can see the alignment with the CEO's vision of the business. And in terms of getting prepped for a sale, and this is where it can get complicated, because this is where you get the circle of trust. sometimes the owner entrepreneur may not want to bring in the management team. I mean, obviously, at some point they're going to have to. But even in advance of that, just having a very well articulated strategy and vision for the practice, for the business, I think is absolutely key in getting those higher valuations for the business.
So is there cool ways that you've seen people, because I think that, you touched on a tricky part where, like, do you bring your management team in or not, and when and how? Like, I mean, do you tell your management team that you may or may not want to sell at some point? I mean, is there a way, some interesting ways you've seen people align their management team financially with them, whether it's like phantom stock bonuses, or like, upon deal closure? I mean, is there a typical kind of couple structures that you see people do to give them the confidence to bring everybody on board?
Yeah, and I would say, all the ones that you mentioned are certainly ways to incent the management team to continue with the business. But I would say, really first and foremost, it really kind of works, on both sides. Certainly, if you are selling the business, you can certainly incent your team to what your control is to, let's say, whether it's a bonus, whether you're going to give them some additional shares towards the end of the business. That's certainly one way to do it. But I'd say, first and foremost, it really behooves the buyer in terms of them reaching out to the management team in terms of how they're going to incent the management team that's coming over. What does that look like? Because I think that's obviously very, very important. As much as the seller wants, the management team to stay in place through the sale process, it really is also the buyer. I mean, what is the buyer going to do to incent the management team that they choose to retain coming over? And that can be, through a variety of, it can either be, if it's, it could either be through stock, it can obviously be through cash and bonus, and I'd say, most importantly, through retention agreements and non-compete. So, I'd say a combination, really of all those. But I'd say first and foremost, it's having that management team. If I'm a buyer, I want to make sure, and this management team is coming over, I want to make sure that I am aligned, and the management team that's coming over is aligned with the strategic direction that I want to take this business. And, and that has to happen first. Assuming we get that alignment and we both agree that this is where the opportunity is with this business, this is the direction we want to drive it. That's step one. Step two then is, how then do we share in that success? Whether that's going to be through a, let's say, a stock program, or it's just going to be straight up bonus, we can deal with that.
I think it's huge. And I mean, it takes work to develop your rock star team. So, I mean, I think, and I don't know if you see people make decisions quick, in being able to flush out and find that team, because it's a pain in the butt to find people that share the same vision of you and are also rock stars.
Yeah, look, I mean, it's the old adage, do you go with a management team and a B business plan, or do you go with an A business plan and a B management team? The answer is you need the A team if you want to be successful. And I think what's so critical if you're on the buy side of this is making sure you've got the right management team that can help you execute. Now, maybe that team, if this is a business that you're in, you may have the A team already, in which case you're not as reliant on the legacy team of the target. If you're a private equity team, you're betting on the management team that you're buying, which you can augment through your network of operators that are within the business.
A huge advice. And I think it's so important because a lot of people, as they're trying to scale their businesses, I think that's where a lot of businesses get like stuck because it's coming out of their profits. The people that are the A team cost money, and they're smart people that want a part of the upside. So people tend to not do that for the short-term game when realistically they're impacting the value of their company.
No, absolutely.
So, Bill, as we're kind of wrapping up here, we talked about a lot of different topics. Is there one thing that you want to maybe highlight out of the things we talked about, or maybe we didn't touch on something that you want to leave the listeners with?
Yeah, no, I would say for the listeners that are listening to this, obviously they're focused on the M&A market. I think this is, in my career, this has been the most exciting market, that I've ever seen. So we have, all types of things that are coming together. We talked about disruption because of innovation and the digital world. And now we see convergence of sectors. And on top of that, we have, the additional juice from an economy that's growing at perhaps more than a 3% clip, with the additional incentive of tax reform on top of that. So I think 2018 is going to be a blockbuster year for M&A. And for all of you that are considering M&A, I wish you the best of luck.
I love it. Bill, what is the best way to get in touch with you?
I'm on LinkedIn. It's Bill Casey, EY. And love to hear from you. Love to hear your questions.
Love it. Thank you so much for coming on the show.
All right, Ryan. Thank you.